Turkey's silver buying came off the back of India confirming they had officially imported more silver in just 1 month in September than they had imported in the entire previous 12 months. Now that has to have your attention.
Upon the breakout, gold's going to make a new all-time high.
Gold-backed ETFs seen inflows of over $5 billion.
$0.8 trillion gold market.
Why are we the only guys that seem to understand this?
Makes your head spin.
All right, hi there. This is Shane Moran, and welcome to Live from the Vault. As you can imagine, the Live from the Vault community keeps growing every week. We thank you so much. We've got some amazing information coming up. Look, what you're about to hear can only be found right here in the Vault, nowhere else on the planet. So we're glad you're here. And don't forget, just before we go to Andrew and Talking Gold, please keep spreading the word about this channel by liking, by, smash that subscribe button, and then click on the little bell there to be notified as these episodes get posted live. So with that, we're going to head over to the UK and Talking Gold for a massive show today with the one and only Andrew Maguire.
Shane, great to be with you again. And wow, 51st episode. So looking forward to catching up with everybody.
Yes, we're going to go into our last video in a second here, but because the feedback has been phenomenal. We'll get to that in a second, but as we always start off, Andrew, you start off by analyzing the short term in gold and silver action between the episodes. There's a lot going on, it seems like, and now our regular viewers are going to really be tuned in to the battle that's going on between the paper and the gold silver markets, the real wholesale physical. What's going on? What is it telling us right now?
Yeah, Shane, and that is, it's a major focus, especially, look, you can probably see behind me what's going on in the charts here. Really, what I'm trying to draw attention to, and really the focus is this unsustainable degree that the highly leveraged paper markets have diverged from extremely bullish real supply demand fundamentals. That's the key of it. But it's how this divergence has reached these unsustainable extremes. Now, if you remember last time, we were very much focused on the Bank of International Settlements Options Expiry. And this is a huge mark-to-market event, and it's been going on for years, and it usually results in a low being made. And we warned about at the end of October, we'd say it was coming up at the end of October, as it had in September. And it resulted in a coiled overshoot of fair value. And when I say fair value, I mean fair value that's nothing to do with just the physical market. That's fair value based on the paper to physical supply. And obviously the paper supply is so dilutive. It's really shouldn't be really calling it fair value, but we have to because that's what we're looking at. And these are the physical support levels, and these were once again driven by the need for officials through the Bank of International Settlements Gold Trading Desk to mark as many unallocated gold positions as possible to market at the BIS OPEX last Friday. And that's since the last episode. And these are the unallocated positions that they are racing to exit ahead of Basel III gold NSFR compliance in just 9 weeks from now. And I think people, we tend to lose sight of this battle that's going on. And so what we're saying is, let's dig into that for a second, because if we look at the detail, it actually exposes some very bullish information. And as we assessed last time, there are very strong physical drivers that we suggested would force the BIS to raise this month's, the October, price cap sweet spot from the 1750 to 1775 September level. If you remember, that's exactly where it closed, into a hell for leather capping event. This is a panicked capping event just to contain physically driven gold as deep as possible below 1800. In fact, the BIS for October closed just inside the lower band of the 1785 to 1795 sweet spot that we'd identified. But the fact is, it had risen. Now, this may not seem much, but it does make a change. It marks a change in their stance. The synthetic gaming into the chart-painted PM fix on BIS OPEX last Friday, it was just far too obvious not to be officially sanctioned. Now, just has been the case into every BIS mark-to-market event, it always marks the expiring month's low point before the official cap is lifted. Now, obviously, we've got FOMC, we've got non-farm payrolls to come, so obviously that follow-through usually comes through, but it always marks the low before the official cap can be lifted. Now, this warped balance, and again, inverted comma balance, is achieved between what the BIS can mark the spot price to market at the PM fix, then it moves into clearing the FX price 1 hour later, where then the FX price squaring is where the unallocated gold FX longs are squared off against the dollar at the FX fix. Bear in mind that is a foreign exchange transaction. That's squared at that hour. Then the final squaring of the directly related COMEX GC contracts, which they also have at the pit close. So that's basically the equation. Just because I get so many questions on this, and how do they determine this fixed price? This established a balance price of $17.83.90. Okay, that's $27.30 higher than the September BIS mark-to-market event, which was at $17.56.60. So why are we taking note of this? I mean, it seems so insignificant, but the raising of the BIS 3-month-old sweet spot was attributable to just one thing: very strong physical demand, which we'll dig into in a second. But the reason we're taking note of this seemingly insignificant stair step, which could easily be overlooked, and I'm sure is, we have to remember the scale of these official mark-to-market derivative events involve billions of dollars of derivative position. So each dollar is billions. So bearing in mind the bearish for gold, strong dollar, rising bond yield drivers. So we talked about how the algos, neutral algos, just tag the relationship with gold or silver futures with bond yields or the dollar. And it provided, because they were bearish into BIS OPEX, which is not a coincidence, it provided really some very assistive bearish tailwinds to drive the paper price, gold price lower. But it still resulted in a $27.30 higher stair step, where at best estimate, we're probably some 350 tons right now of unallocated gold derivative positions needed to be marked to market. Now, this actually represents, if you think about it, 550 billion, and that's a backtrack of 550 billion from September higher, and exposed really more than just a chink in their armor. Now, these are the kinds of things we are looking for. Changes in behavior. Now, bearing in mind the BIS OPEX is all about closing off as many long official unallocated over-the-counter gold contracts, as many as possible before they are rolled onto the books of the agent banks on the 31st of December. Onto which they've laid, if you remember, we've talked about this before, BIS has not sold a single physical ounce. What they've done is create unallocated contracts, leased, swapped them out, and laid them on the books of the banks, of the bullion banks, who are privileged to have gold accounts at the Bank of England. So, but the process of squaring up 100 to 1 leveraged long XAU contracts, which is the gold spot gold contract, where only 1 ounce backs up each contract, involves buying back the dollar leg of this foreign exchange transaction to close off these obligations. And we've explained this before. And the plain vanilla price action that revolves around this action really sends a counterintuitive message to the market, which leads to a price action, and that looks bearish. Now, whereas this process bullishly removes In reality, what it's doing is removing some of the 50 years of COMEX-related accrued overhead synthetic supply. Now, while the COMEX is already Basel III compliant, what we're drawing regulators' attention to is that the CME accepts the over-the-counter paper longs, 100 to 1 longs, bear in mind, as legitimate long hedges to what would otherwise be classified as a naked short, non-compliant Basel III position, which cannot be tolerated in the US the US is actually now Basel III compliant. What this would do, it would also expose that the degree of these so-called hedged positions actually exceed position limits, because there are position limits, and you can get around those position limits by saying, no, I'm hedged. But so really, this is where things are beginning to change. So bottom line, these over-the-counter longs that offset the COMEX shorts are deemed as acceptable hedges for COMEX shorts. And that circumvents the current Basel III COMEX compliance. Hence, these games continue for the moment. However, ultimately, both the COMEX and the over-the-counter markets must one-to-one represent deliverable physical bullion in just 9 weeks' time. So we must expect intermittent counterintuitive volatility as this scramble to close or allocate these so-called hedges is underway. Now, especially as we move into a BIS OPEX event, and there are only 2 more. So really for November, given the seasonally unprecedented central bank and sovereign physical buying that we are experiencing now, and we'll get into that in a minute, we expect the BIS sweet spot to be driven pretty much a little bit higher than we estimated last time. Somewhere 1850 to 1830 would not be unreasonable. Likely with some, this time, 280 tons of remaining unallocated contracts laid on the books of these agent banks who have gold accounts with the Bank of England. And then the BIS has the option of squaring whatever's left with a keystroke entry. We've talked about this before. And after that, a large rally into the year end will be allowed to unfold with the BIS on the long side of a US dollar gold price reset.
Given today's current, I guess some would call it counterintuitive. Someone like me would say like this price action just doesn't make any sense. But what you're saying here is encouraging, especially for stackers. Now, a lot of subscribers are asking, Andy, and they're looking for maybe some short-term guidance. Let's say, call it between now and between our next episode in 2 weeks. Can you give us some insight into what might happen here? Because there's a lot going on.
Yeah, and again, I can understand why these questions come up. You only have to look at the action. Yes, Shane, I'm really happy to share my view on this. And more immediately, as we commence November trading, the need to cap BIS gold below 1800 into very strong, unanticipated US physical demand. And this is something that's been missed. There is very strong US physical demand for the October mark-to-market event. And so really this is end up coiling gold for a very large move higher now that this official cap will expire. Now, obviously, we're recording this on Wednesday before FOMC tonight and non-farm payrolls on Friday. So we expected the obligatory spec wrong footing to continue into these high frequency trading algo driven events. But thereafter, for next week, given the paper to physical disconnect, which we can see, we now see the higher official stair steps, although flying under the radar, just now revealed here in October. We see the strong physical driven gold market to accelerate and force higher prices into the end of November. And after this, in December, the Basel III squaring will have to conclude, and any remaining unallocated contracts will have to be fully allocated. And that's important. And by the time this episode is released, will be between FOMC, which obviously I don't have a wizard's hat. I don't know what Powell's going to come out and say tonight. But this will be released between FOMC and non-farm payrolls on Fridays. So unless Powell pulls a rabbit out of the hat that we can't expect, that we didn't expect, what I would think is that because his nomination is in question, he's not going to ruffle any feathers into this meeting. And we see really non-farm payrolls as taking a back seat to FOMC. Now, let's face it, the Fed has all the non-farm payrolls data already. And when Powell steps on the podium and the statement to the presser, it's going to be a directional capitulation point at that point. I think because non-farm payrolls data is known, so it will be encompassed in their statement. And the hawkish spin really has already been kind of baked in. And if there are any surprises, it'll play out at FOMC, not non-farm payrolls. So with physical stackers in mind, with the Fed already having spilled the beans later today, the hugely underpriced buying window may well be an optimum time to add positions inside this FOMC non-farm payrolls window. And I say this with stackers in mind. And really, to best illustrate the massive divergence that we were talking about, Shane, a minute ago, between the strong physical gold and silver markets versus the current paper market action, one really has to look no further than the much easier to read silver market.
Awesome. Well, Andy, you're bringing up silver now, and I'm just smiling because of all of the comments. And I have personal friends that are calling me and talking about silver. All of a sudden, silver, 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 and they just loved, that clip of you in the vault and all that. Now, you just shared with us just before going live here that you've got some very important information. That's why I'm saying only in the vault. Live from the vault can you get this type of information, but you just uncovered something this week. Can you share with our community what's going on here and what you uncovered?
Yeah, and this is why it's so good to have this channel. Shane, yeah, this information actually that we talked about before, and I'll spill now, is this information kind of reaffirms what a huge physically driven paper leveling buying opportunity is actually upon us. And you wouldn't see it by looking at this paper chart, these paper driven charts. So yesterday afternoon, which is Tuesday, which is Wednesday here, just as silver was heavily sold at the pit open, and we know what happens, you know exactly where the pit opens. You just have to look at any chart and you'll just see a spike down. And again today, we received information yesterday from one of our largest silver suppliers, somebody that provides the big majors, that Standard Chartered, yep, the very same COMEX market maker, have now tapped out and front run every single remaining ounce of silver not already contractually locked down, leaving zero wholesale supply deep into 2022. So look, let's just kind of sum up what we're seeing in this extremely strong wholesale market, wholesale silver market, because silver stands out. And as we discussed in our last episode, we broke news that Turkey had just come out into the silver market to scoop up some very large size wholesale silver, and that was 2 weeks ago. Now, inside sources had already estimated it was 346 tons had been imported by the third week in October, significantly tightening global supply. And we reliably hear that actually continued into the end of October. But by no coincidence, Turkey's silver buying came off the back of India confirming they had officially imported more silver in just 1 month in September than they had imported in the entire previous 12 months. Now that has to have your attention. This does not include smuggled silver either, which is pretty hard to estimate actually, unlike gold, which the World Gold Council even admit in the past, that it amounts to probably 30 tons of gold smuggled per month. So can only imagine how much the silver is smuggled in. But we're talking about auditable, official import data. So the last time India imported over 500 tons, which it did in a single month, in September, following a 13-month hiatus where they bought almost nothing, September matched a level of imports not seen since April 2020. Now, if we draw a wholesale market comparison, the last time India imported this quantity of silver, it was when silver was trading $10 lower at $13.90. Now, following this level of competitive buying, silver actually rose $16 to $29.9 over the next 4 months into a very similar supply shortage. In fact, we've not seen such a supply deficit since March 2020, where silver was at $12, and it telegraphs much higher silver prices. So don't be fooled by this absolute counterintuitive behavior that we're watching right now. And also, what is little known is that China has been importing silver, as well as China non-monetary gold imports from Switzerland have now auditably exceeded imports from 2019 and 2020. And I'm sure that's Basel III related. But that doesn't account for hidden central bank monetary gold buying, which we know referred to many, many times, at least exceeding 25,000 tons, if not more. But we're talking about auditable stuff here. So Shane, regarding silver, when one considers that this extreme tightness in upcoming silver availability now stretches deep into 2022, just off the back of Standard Chartered aggressively locking down 2022 supply, and then compare that to the counterintuitive COMEX-centric paper silver action evidenced yesterday and today into this FOMC gaming, it leaves little doubt that current dislocated silver prices are going to be very short-lived. I mean, silver is so compressed for a large physically driven move higher at this point. And what we're seeing in the COMEX-driven price action is COMEX pit sellers. This is important to understand. How is that possible? How is all of this buying, physical buying going on, and forward buying, supply into deep into 2022? How come the price is collapsing? I need to explain that. It's the pit sellers tricking the specs into selling, and I'll explain how that works in detail. But these non-market making participants, they have no visibility into the offsetting spot index physical related longs that are supposedly hedging these COMEX shorts. So as we evidenced yesterday by this market maker, Standard Chartered offsetting, what they were doing was they were buying spot silver, and they were then offsetting the COMEX shorts with this smoke and mirrors over the counter longs, which are acceptable in the CME's eyes. Now, so psychologically drained spec sellers are tricked into believing, because they see just one side of this equation, that these COMEX sell orders that come raining in are naked short bets. But they miss the fact that on the other side of these COMEX short sales, insiders are busy locking in, spot indexing, buying, in other words, silver at every refiner and producer we have spoken to. And so, I mean, it has to be understood that the momentum-driven spec silver future sellers, they've tricked in the spec short sellers, and they just don't see that the largest silver buying versus the tightest silver shortages evidenced since March 2020 are actually upon us. And what they're reacting to is the blinkered view of just one side of a transaction, namely the short sold COMEX hedge positions being added from the likes of Standard Chartered and others who are going long spot over-the-counter silver positions. This is driving the paper to physical disconnect to a point not seen since March 2020. I cannot say this enough. So very, very short term, following this race to physical, European refiners we spoke to already, such as Argor, will have no supply for sale in the new year at anywhere close to current prices. This makes this counterintuitive gamed blinkered silver discount what a rare opportunity, guys.
This is really interesting, Andy. You know, we were talking India with massive purchases. You brought up China again with massive purchases. But the information that just came out this week, it comes at a time when paper, I guess, let's call it paper silver, you know, was being sold right into the casino. Now, I guess our community understands what the paper casino is all about. How is this happening?
Shane, gold is also in strong physical demand, and see, people, you know, that's why we kind of focus on the silver market, because it gives us a much better view into these exact same actors and what they're really doing in the harder to read gold market. And what it's doing, the specs are suffering from the same spec wrong footing from the casino. And this week, following gold buying that ramped up in October, Turkish buyers have now moved aggressively into the gold market, hunting out and emptying out physical gold from two known European bank sources that we know of this week. Now, we're trying to do some more digging on this, but if they drained those two banks in Europe, you can bet your life there is more going on here. And if you think about this, it makes total sense. And there's a very good reason that every single central bank is accruing physical gold. As we have just discussed a minute ago, Basel III compliance is just in 9 weeks from now. And so while COMEX is, as we've said, Basel III compliant, it's important to understand this. The weak link is this offsetting paper hedge. It's just a paper hedge from the over-the-counter market. This enables the gaming to continue. But by the 1st of January 2022, every single ounce backing the COMEX short must be physically allocated. This ends the 50-year game and is why every central bank is buying dollar price gold. And this includes the BIS, who after January will be long dollar price gold in the FX markets to hedge its rapidly depreciating dollar exposure. Now, not that you would see it by the paper-driven action, but yes, Shane, gold is also in very strong physical demand, and we're evidencing the same unsustainable divergences between the physical and the paper markets. So very, very short term, while we expect the specs to be once more wrong-footed into these obligatory few sessions following such a large psychological operation to discount the price, and we've got the Fed due on the podium later today, and as always, the HFT, the high frequency trading bots, the game non-farm payrolls on Friday. There are two immediate, between all of these things, there are actually two very immediate underpinning bullish drivers for both paper and physical gold. And it's important to have the two drivers in place, not just the one. The first one is onerous tax measures. So the very strong US physical demand that we reported evident into our last episode picked up last Friday, the 22nd of October, and once again was confirmed by refiners each day of this week. And it confirms Swiss refineries have been busy fulfilling unusually large US physical gold orders from investors, US investors, seeking to preserve their wealth in the face of onerous new proposed tax measures. These are scary tax measures. So physical inflows of this size have not, again, been seen into the US since March 2020. These are important milestones. And the second thing that we mentioned is driving bullish physical demand, as well as paper demand, is a perceived Fed policy error. Now, the Fed allowing inflation to overshoot its 2% target depends on their assessment that inflation is transitory. And there's a growing skepticism amongst market participants. This maybe is not the case. And uncertainty and the need to hedge ballooning risk-on positions following the plunge in real yields midweek last week is telegraphing that the Fed has very likely made a massive policy error. And the gold market is beginning to price this in an already baked rate hike gold scenario. Well, it's already baked in, guys. So, where's the risk here? And as far as gold is concerned, this is also incentivizing COMEX-centric paper gold safe haven buying to lay off some of this risk. Now, for any gold or related silver intra-week rally, and we look at it in a weekly terms, for any rally not to be gap closed, how many times have we seen it rise in the beginning of the week and get smacked back down in the end of the week? It's because it's driven by the paper market. But if you have both markets in tandem, both markets buying, it requires both of these markets to stop these gap closes and the unleveraged physical markets to step up in tandem. Now, we currently have these conditions, which is not seen since the 1970s, actually, and most recently structurally, as was evidenced into March 2020. So these two drivers alone price physical gold following the BIS mark-to-market event that we keep grinding on about, but it's just so important because it prices it at least $300 under fair value. And once this wrong-footed BIS mark-to-market coiled action begins to unravel, probably after Fed today or non-farm payrolls at the latest, a very large stair-step rally will ensue. And it's going to be physically driven. And this may well overshoot current gold market resistance, which is, we know, 1830, 1835. That's everyone's looking at the same resistance level. But we do not count out the BIS. We can see a possible overshoot, but we don't count out the BIS bringing price back to this level on any overshoot into the end of November. So we have to be careful here. Now, obviously, we'll provide an update on this well ahead of this in our next episode.
Andy, that is awesome. Lots of that's why I love this. I get all fired up when I hear what's happening. I'm hearing it in real time as well. But here goes. Buy physical. I'm getting a lot of calls on this, and really, we want to thank everyone in the community for helping other people also understand the difference. What Andy affectionately calls the casino paper and gold and silver markets, and the actual physical gold and physical silver markets. They are not the same. And so there you have it, everyone. That's all we have for you today. Another fascinating episode of Live from the Vault. Please help spread the word, share the channel, hit the like button, hit that subscribe button, and click on the bell if you want to be notified as these episodes go live. And with that, we'll see you next time on Live from the Vault. See you then. Bye for now.